You pull out your phone, tap twice, and money moves. It happens in under a second. It feels like magic. But underneath that tap is a system so fragile, so dependent on trust in invisible institutions, that for most of human history, it would have seemed completely insane. There was another system, an older one, and by nearly every measure that matters, it worked better. It had no coins, no paper, no banks, no interest rates, no debt traps, and yet it moved goods across thousands of miles, fed entire civilizations, and created social bonds so strong they lasted generations. Economists who study it today call it one of the most elegant financial systems ever devised. The people who used it just called it life. This is the story of the gift economy. And once you understand how it actually worked, you will never look at your wallet the same way again. Before money existed, humans did not simply barter. That is a myth economists have been quietly correcting for decades. Anthropologist David Graeber spent years dismantling the barter myth in his landmark work on debt and human history. He found no evidence of societies that operated primarily through barter between strangers. What he found instead was something far more sophisticated. People gave freely, strategically, and with a long memory. In a gift economy, you do not trade a fish for a basket. You give the fish. No price is set. No immediate return is expected. But the giving is not random. It is tracked, not in ledgers, but in reputation, in memory, in the social fabric of the community itself. Your neighbor gives you meat after a hunt. You remember. Months later, you give them grain after your harvest. No contract was signed, no interest accrued. But the debt was real and everyone knew it. Anthropologist Marcel Mauss was the first to study this systematically. In his 1925 work on the gift, he identified something remarkable across dozens of cultures on every continent. Giving was never truly free. It always carried three invisible obligations: the obligation to give, the obligation to receive, and the obligation to return. Refuse any one of those three, and you were not just being rude. You were breaking the social contract that held the entire community together. This was the engine. The gift was the currency, and generosity was the credit score. Now think about what that actually meant in practice. In a hunter-gatherer band of 50 people, everyone knew everyone. Your reputation was your bank account. A skilled hunter who shared freely became wealthy in the only currency that mattered: trust. People brought him problems. People protected him. People fed his children when he was sick. His generosity was an investment with returns that compounded over a lifetime. Meanwhile, the person who hoarded, who took without giving back, who broke the cycle, they did not just lose friends. They lost access to the entire network. In a world without supermarkets or hospitals or insurance policies, that was essentially a death sentence. Economist Marshall Solins studied hunter-gatherer societies in the 1960s and discovered something that shocked the academic world. These people, whom everyone assumed lived in desperate scarcity, actually worked fewer hours per day than modern humans. They had more leisure time, more rest, more social connection. Solins called them the original affluent society, not because they had more stuff, but because the system they used to share resources was so efficient that it met everyone's needs without the grinding anxiety that modern financial systems produce. Let that land for a moment. The people with no money had less financial stress than you do. The gift economy scaled, too. It did not stay locked inside small bands. Across the Pacific, indigenous trading networks called kula rings moved ceremonial objects, armbands, and necklaces across hundreds of miles of open ocean. The objects themselves had no practical value, but the relationships they created, the obligations they established, the prestige they conferred on generous givers, those were enormously valuable. The kula ring was not a curiosity. It was a functioning long-distance trade network that operated without a single coin for thousands of years. So why did money replace it? The short answer is scale. When cities grew beyond the point where everyone knew everyone, reputation could no longer be tracked by memory alone. You cannot remember the giving history of 10,000 strangers. You need a symbol, a token, a number, something portable that carries the memory of value without requiring the memory of the person. Money solved that problem, but it created new ones. It disconnected giving from relationship. It made transactions anonymous. It allowed debt to be abstracted, packaged, sold, and weaponized in ways the gift economy never could. The moment money appeared, inequality followed. Because in a gift economy, hoarding is socially impossible. Your excess must flow outward or your reputation collapses. But in a money economy, you can accumulate endlessly in silence, behind walls, in accounts no one can see. You live inside that system right now. You tap your phone, and money moves. But the anxiety that comes with it, the fear of not having enough, the isolation of financial stress, the feeling that you are always one bad month away from losing everything, that is not a universal human experience. It is a very recent invention. Your ancestors had a different relationship with value. They measured wealth not in what they kept, but in what they gave away. The most generous person in the village was the richest person in the village. Not metaphorically, literally, because generosity was the system, giving was the currency, and trust was the only bank that never collapsed. Tonight, when someone does something kind for you without asking for anything in return, your brain will feel a pull, a subtle pressure to reciprocate. That feeling is not politeness. It is not social conditioning. It is 50,000 years of financial memory, still running in the background, reminding you how wealth actually works.